Welcome to another Infographic Instant with Brian Michael. In this episode, we'll be looking at the question of whether size matters, namely, whether the size of a company, as determined by market valuation, correlates with corporate governance practices and the effect of those corporate governance practices on market valuation. Before we talk about the infographic, we should note that this infographic comes from a larger paper which tries to assess the changes needed in Hong Kong in order to improve corporate governance practices. In theory, by improving those corporate governance practices, Hong Kong can attract more international portfolio investment and therefore grow in stature and, of course, profitability as an international financial center. Now, turning our attention to the infographic, this infographic is a little bit harder to read than some of the ones that we have seen in the past. Basically, we're looking at two variables. The first variable is size, and we look at high-valued companies, namely those large companies with a large market capitalization, in this dark solid blue. And we look at smaller, lower market cap companies in this dotted lighter blue. Therefore, when you see the differences in these bars, what you're looking at is differences in company sizes. On the x-axis, we look at corporate governance scores, and namely try and understand the difference between those companies with worse corporate governance scores on the left-hand side of the graph and those companies with better corporate governance scores. The dependent variable for this graph is the market premium given for better corporate governance. So in other words, if a company has better corporate governance practices, does that increase the premium that investors will pay for that company? The measure that is used in this infographic is Tobin's Q, and particularly the change in Tobin's Q. Tobin's Q, just to remind all of us, is the difference between the market capitalization, or the value of assets that the market places on a company or assets in those company, and the replacement or accounting value of those assets. So, for example, a desk might be replaced for $100 going to the furniture shop, yet if there's something intrinsically more valuable about that desk, the market could assess a value of $200, $300, even more for that desk. The difference between the market value and the replacement or cost is defined as Tobin's Q. Now, let's turn our attention to the infographic you see in front of you. We see on the left-hand side the change in Tobin's Q in that market premium for worse corporate governance practices. So as corporate governance practices get worse, for large companies, we see a very large decrease, roughly 25% in Tobin's Q. That means for these large Hong Kong companies, as their corporate governance practices get worse, they see a significant 25% decrease in the premium that investors are willing to pay for those companies. For small companies, however, as shown by this very tiny bar you see on the left-hand side, for those small companies, there is a very little change in the market premium, and indeed it looks as though worse corporate governance practices might actually very, very, very slightly benefit these small Hong Kong companies. However, of course, this effect is so small and potentially even non-statistically significant. Therefore, it's very difficult to say for sure that naughtier companies would necessarily attract more investment. Now, let's turn our attention to those companies with better corporate governance practices and look at the effect of size. We see that for larger Hong Kong companies, that as their corporate governance practices improve, we see an increase in market premiums as measured by Tobin's Q. However, what's particularly noteworthy is that this effect, the market premium paid for smaller companies, is higher than for larger companies. And that market premium can approach even 10%. So the moral of this graph, I think, is that bad corporate governance hurts big firms and good corporate governance helps small firms. There's this asymmetric effect in corporate governance practices, meaning that small Hong Kong companies should really try and improve their corporate governance practices, whereas in large Hong Kong companies have to be vigilant because any deterioration in their corporate governance practices will cause a significant decrease in the premium that investors are willing to pay for their shares. This has been another Infographic Instant with Brian Michael.